Welcome to your CPA's take on real estate. In today's session, we're going to talk about estate planning for real estate investors. I'm your host, Daniel Roccanti, back with Kyle Paxton to talk about a subject that I think is very timely for a lot of real estate people. When people hear real estate or estate planning, they usually think about wills, trusts, and who gets what. But for real estate investors, estate planning is much bigger than that. It's about who gets control of the portfolio, who manages the debt, who talks to the tenants, and how the family avoids forced sales and tax surprises.
Oh, yes, Daniel. And there's a lot of nuance to this, right? Because when we talk about a real estate portfolio, you could have the rental properties, development entities, debt guarantees, some minority investors. When family members get involved, in a real estate investment, things can get weird. Property managers, operating agreements, the whole shebang. So oftentimes what happens is we have an individual or a small family office who has done very well in real estate investing in a short amount of time. And then as we start getting through these conversations on transition planning, what's it going to look like for the next generation? People can be quick to say, I'll gift this property to my son, whatever. And so definitely a spot to stop, full stop, take inventory of everything, figure out what's what and get the right people around you. Cause this is a super important conversation and can save a lot of headache, money, and tax. In the estate planning process.
Yeah, Kyle, and real estate specifically just has a couple special things that goes on when you're talking
Yeah.
about planning here. Real estate is usually very illiquid. It's
Yeah.
high leverage. It's entity heavy. So you're talking sometimes with some of these families, there's 30 entities plus sometimes. And so that can make for very complex estate planning. So
Yeah.
for this, our real estate investors, a good estate planning should answer 5 questions. Who owns the assets after death, basically? Who controls the entities or the real estate? Okay. Who has the authority to manage, refinance, sell, distribute cash, things like that with your real estate? How will taxes, debt, and liquidity needs be handled? And then how will active and passive family members be treated fairly? Because as Kyle and I know, not everyone wants to take over the real estate and be active. You're going to have a mix of that. So let's break down into the structures investors use here, Kyle. First, kind of coming up here is most real estate investors are very familiar with LLCs.
Yeah.
Okay. I mean, if you're buying real estate, you're putting them in LLCs. That's usually how it goes, especially once you're scaling up there. So I think most people are aware of that, and that's great for asset protection, especially while you're alive. But, LLCs really are just common for asset protection here. But estate planning needs to take it a step further and who actually owns each LLC's interest, because multiple people can own it. All right. Who's managing the LLCs? Whether the ownership interests are voting or non-voting, okay? Whether the transfer to the family, to a trust or family members are even permitted, and then whether lender consent is needed before ownership changes.
Yeah. And this is all about governance, and governance really matters in that situation, right? Where the goal is not moving around, not just to move value to that next generation. It's deciding who's making the decisions and when, important point, who gets the economics, how are decisions made for sales, refinance, property management decisions, all of that. And it gets very nuanced and complicated. I want to really kind of get back to, I don't necessarily want to focus on the value and the money proponent in this whole conversation, but real estate is a liquid, and that's huge in this, right? So as part of the estate planning, we have to understand where cash flow is coming from. If you actually have an estate tax liability, how are the next generation going to cover that if all of that wealth is covered in real estate? Big conversation. Another vehicle I want to bring into the picture here, Daniel was talking about LLCs. He opened the conversation with starting basically the first thing you think about is kind of wills and trusts in the estate planning process, right? So there are two big buckets of trust, right? You have revocable trusts that help avoid probate and centralized administration of your assets. Um, and irrevocable trusts are often used in this estate tax planning process for additional asset protection or generation skipping planning. So this is, as we get into this conversation, to me, the trust conversation is low hanging fruit here, right? What trust could we possibly set up to streamline this process? How does that impact ownership of these LLCs we've been talking about? Are there any gifting that needs to happen now of LLC interest and or direct property into these irrevocable trusts? And so the design of this all comes around whether the trustee has the skill or authority to operate real estate, sign leases, manage debt, capital calls, do tax elections. So all of these factors come into this conversation, but really, we take a hard look at trusts as a vehicle within the estate planning for real estate because there are a lot of benefits there.
Yeah, trusts are very popular when it comes to estate planning. Anyone that's done any level of it or even talked to someone knows that
Yeah,
usually trusts at some form come into it. Kyle mentioned the revocable trust, very common across the
yeah,
board, doesn't actually take anything out of your estate at all. But so it's mostly just there for probate avoidance and things like that, making it easier to transition and things like that. But it still stays within your taxable estate. That's important because irrevocable trusts take it out of your taxable estate usually.
yeah,
And so this is starting to get into what am I going to start reaching inheritance tax? And so
yeah,
with the most recent tax code and everything, that's turned into 15 million per person. So a married couple gets 30 million before inheritance tax. So that's their exemption. So that means if wealth is over 30 million, the amount over 30 million will then be taxed once it's given to their inheritance. And that can unfortunately go all the way up to 40%. So
yeah.
it's
Exactly.
really quickly, it's very
Yeah,
quickly up to 40%. So you're talking about a 40% tax on your wealth. So people under 30 million are thinking about it as much, but when you start bringing in over 30 million, so you have $100 million worth of real estate, you're looking at a very hefty tax bill, unfortunately, once you're passing away and you're gifting it to your kids. So it's really important that we talk about trust here. Another really common entity that we see for estate planning here is this kind of family limited partnership or these family LLCs. And what this is really doing is just basically kind of going off what we normally were talking about the LLCs before, but you're putting it all under one big one here. And this really creates kind of this separate controls from the economics. All right. This is so that the senior generation can really retain management control while still transferring non-controlling interests to the kids and a lower generation so that we can start getting them into this real estate without directly giving them real estate. And so, but these structures, they need real governance, they need real records. It really needs a business purpose beyond tax. And so when you're doing these things, it's very important that you structure this like any other business. But it's a very important tool, especially for estate planning of how I can start giving away to my kids and start estate planning my real estate without having giving them direct interest in the real estate.
yep. Daniel, let's dive into the part of this that really excites me, right? Talking
Sure.
about the step up in basis. Just at a high level, if you're not aware, in general, property, we're keeping real estate focus here. This is the case for all assets, but in talking about property acquired from a decedent receives a step up in basis equal to its fair market value at the date of death, or potentially an alternate valuation date if elected through the estate process. This is huge for our real estate investors, right? So the classic real estate playbook is you acquire a property, you take bonus depreciation on the portion of the property, which currently, as this video is being filmed, is 100%. So that eligible assets get 100% write off in year one. The catch of that, of course, is depreciation's a timing difference when you go and sell on the back end, barring 1031 like kind exchange or some other strategies. You have a taxable event on the sale to recapture that depreciation. The step up in basis as part of this transition planning is huge because you can potentially wipe out that recapture component, right? And so a lot of our planning around this in the real estate space revolves around, does it make sense to sell now, to gift now, to refinance, whatever it is, if this step up in basis is looming. Can be some awkward conversations because you're talking about somebody passing away, right? But you have to be serious about this and understand that how you go about passing property down can have a drastic difference on tax implications.
And this is one of the most important tax consequences when you're thinking about real estate here. This is
Period.
sometimes one of the reasons why people can get into real estate. It's great for generational wealth because of things like the 1031 exchange when I can keep deferring it. And then I can basically pass away and give it to my kids tax free. Okay. Now it's important though that what we're talking about is income tax. Okay. So
Yeah.
step up basis, basically when you pass away, you give it your real estate to your kids receive it at fair market values. They get a step up basis from your original cost basis to the fair market value. So if they turned around and sold it immediately for the same value, they would have no gain. Or if they did hold on to it, the gain would only be what it appreciates from when they received it in the fair market value. But this is not the same as inheritance or estate tax. Okay. So when you give people things, all right, they received it at their original basis, that your cost basis that you originally had. So let's say I buy a property for $1 million, it appreciated to 5 million. So its fair market value is 5 million. If I pass away and I give it to my kids get it now at a cost basis of $5 million. Okay. But if I gift it to them, they only get it at $1 million. So there's a $4 million built-in gain there. And I'm not talking about depreciation or anything like that, Kyle. We're keeping our example
Keep
really
it
quick.
simple here. Yeah.
Yeah, but there's a $4 million built-in gain there. They get to basically just skip that if you're giving to it. But this is still important because, transferring assets then reduce your estate value. So even though I transferred it and I created an income tax problem, but now I reduce my estate. Or if I hold on to it, I'm reducing a future income tax, but I'm creating maybe an estate. So it's really, really, when you're doing real estate people, and it's complex, especially if you're over the 30 million estate, because you really need to use these trusts, these entity structuring, and then just estate planning in general to really balance here. All right, income tax, estate tax, and then also controls and family goals, because those are all important. But if you don't have it set up for the right controls, the right people taking over, it's just going to, unfortunately, once you pass away, it's going to be a huge mess for your kids and fighting and everything. So it's really important to understand that control piece can just be as important as avoiding the tax pieces as well.
Daniel, I really like this conversation and the tension kind of amongst these planning components. It really speaks to the nuance that's involved here. And I think us as tax advisors, we have a really unique position where when we're working with, we're going to use the term family office for this discussion, right? If you have a family involved here and you have real estate within the family, we get pretty good third-party visibility into family dynamics, goals of the older generation versus the younger generation. And so from my perspective, we add a lot of value to this process of rooting, obviously having the tax knowledge, the understanding of how, these things we were talking about function, but making sure we're continuing to root all of this into what are the actual goals of the family. Are the goals aligned? Do we have to help kind of mediate that? We can be part-time therapists sometimes as CPAs, but this is a very, very important conversation that often happens too late on that setup. And the way I see it, if you're a scaling real estate investor, it's never too early to have this conversation. Because the more complex you get, the more work you have to get everything moved around to the right spot and all that good stuff, right? So I like having these conversations early as we onboard clients and like, hey, year one, let's focus on compliance, but then let's talk estate planning, because there's often work we can do there.
And Kyle, I mean, we always primarily focus on compliance and
Yeah,
income tax and those things, but really, this estate planning gets overlooked,
yeah.
or it's just something that I'm going to push off down the road. That's an end of life issue,
Well, it's an
and
uncomfy conversation. I mean, that's what it is. Yeah,
it's a very uncomfortable conversation. But it's important. It's very important to make sure that you're talking about it as soon as possible because real estate appreciates. I can appreciate really quickly. I can't tell you
yeah,
how many people I've talked to that's like, I'm under the 30 million. And then 2 years later, they're well over the 30 million, like they're one good deal, one good year away from being over that. And now it's like, all right, well, you're already over it and you
yeah.
haven't even talked about it. And then the bigger your family gets, if you got 5, 6 kids and grandkids and everything on that, and it just creates a complex situation. So let's move into estate planning specifically here. Okay.
Okay.
So we talked about the $15 million estate kind of
Yep.
exemption here, 30 million if you're married. So if you are around those limits, you really need to start thinking, okay, it's not just income tax planning, it's estate tax planning that we can talk about. And so what are some of the things that I can do here? And we also need a reminder that some states also have estate and inheritance tax and their thresholds might be significantly lower than the federal. So keep that in mind as well. You're not just thinking about federal stuff here. In Florida, it's easy for us to forget it, but there's other states out there that definitely have them. Okay. I think I can't remember the number, but I think it's about 15 or states have some form of inheritance or state tax like that. Okay. But property values can grow quickly. So I always tell everyone to make sure you talk earlier than you think it will. Okay.
Yeah.
And it's just with real estate, it's really actually tough to track your net worth. I can't tell you when
Yeah.
I talk to people, what's your net worth? And they're like, I think it's this. And I'm like, you could be off tens of millions, like just that real estate for you. Right. Um, and so some of the planning tools here that are great
Mm.
to use is don't forget the annual exclusion. Okay. It's 19,000 per person. This is a really helpful tool
Yeah.
to move something every year. This basically means if I give 19,000 and if your spouses, you can both give 19,000. Okay. So you can gift a significant amount of money to any person in a year. And this doesn't have to be cash. It can be cash, but it could also be LLC interest, things like that. That family limited partnership, it's very common for them to just slowly keep giving them more non-controlling interest in it.
Yep.
The annual exclusion gift seems small, but it actually can really add up over many decades. Okay. The lifetime exemption, that is basically the 30 million that we talked
Yeah.
about. You can definitely use that to move assets before you die. Okay. The common ones that we see in the trust that we were talking about is the spousal lifetime access trust or the SLAT.
Yep.
I've seen this more and more common. So married couples can basically gift themselves and they put trust and gift it and give them. They remain the beneficiary. So for tax purposes, it's still considered disregarded and it's treated just like it. But for estate, it gets them out of your estate right there. Grantor retained annuity trust, grads. This is a great way to shift appreciating properties to beneficiaries. So it can work better with assets that are expected to significantly appreciate. Okay. We've talked a little bit about the family limited partnerships or the family limited LLCs, transferring those interests. So instead of having to transfer real estate, I can transfer just interest in these, a small portion of it every year. And now it just keeps slowly building up. And I can make it non-controlling so they don't have any control. So it doesn't matter that they're getting more interest into my portfolio or the family portfolio every year. And then you can also use life insurance trusts, affiliates. This is a good way to basically provide liquidity. So when you have real estate, it's very illiquid. So if you are going to have an inheritance tax, it's difficult once you get over 30 million to completely avoid inheritance tax. So the question comes down to limiting it. So what's that going to look like? Do I have a way to fund it? Because if I don't, then my heirs are going to have to sell real estate just to pay the tax bill. That's usually not what we want. So life insurance can be really good, um, a really good asset for you here. But just keep in mind, sometimes life insurance, the payout could be included on top into your estate as well. So make sure that it is properly structured to keep it out of the state. Or if you can't, make sure you're aware of that, hey, now I'm going to have to pay estate taxes on the payout of this, but at least it's paying for it. I don't have to sell off my real estate, especially some of that Class A generational wealth real estate. You do not want to sell it. Once you buy it, you can't get it back, especially not for that price.
Oh yeah. One other thing I want to touch on that I've seen a lot recently, we have strong footprint in several college towns, and this seems to be prevalent, with as our real estate investors are getting older, the charitable planning component of all this, right? As part of a lot of estates, our decedents are motivated to have a charitable component to this, and that's something that in the last couple of years they've seen a drastic rise in on my clients being really interested in pulling in real estate into their charitable planning. So that's something we're looking at as part of this process as well. And that can look a lot of different ways in terms of how it's sliced, when it's contributed, how, and again, strategies there around contributing different types of property that have appreciated to help mitigate some of these tax issues that we're talking about.
Yeah, that's a good topic, Kyle. Definitely
Yeah.
charitable comes up a lot. So I want to move on to kind of succession planning here for your real estate actually operators. So we got to remember real estate, it's not really just passive. It's called passive income, but someone still has to manage the tenants and
Yeah.
deal with repairs and financing and distributions and investors and deals. So it's important that when we're doing our estate planning here, we really are identifying who becomes the managers of these LLCs, who communicates with the lenders, who negotiates the lease. So basically, who's taking over and managing these properties, okay? Or at least the high level. They don't have to necessarily be the property managers, but who's taking over all this? And so when you have a family, all right, who has control here? And this is an issue because, like, say you have 4 kids, you have one that's very active, 3 that's not. It's like, okay, the active one most likely is probably the one taking control. All right, what's the family dynamics? How does that look like having 3 passive? Because it can be equal in interest, but unequal in control. And so who's really getting the actual manager duties here? Do they want them? I mean, how many times have we seen it and none of the kids want them? So what does that look like?
Oh,
Well, if none of
yes.
the kids want any of the duties, okay, now that's an even bigger conversation because we now have to find a third party, a trustee or someone to do it, or the kids are just going to sell everything and take the money.
Yeah, this is often where I see those tensions we've kind of talked about around family dynamics come to play, right? When there's a mismatch in family goals. And so, this process has to be intentional. You talked about separating ownership from control. Very important to define what the ownership and the control, and fairness and equality get a little convoluted here if someone's doing the heavy lifting. And so, like, having these intentional conversations on the front end saves a disaster on the back end. And, we've talked about internally a lot of times, within a family dynamic, um, everything can be hunky dory until, we'll use patriarch as an example here, of the family business passes away and then everything falls apart, right? It's almost like a switch sometimes. And so, really being intentional about that separation of ownership and control, and then preparing the next generation, make sure everyone's on the same page. You're involving the successors before a crisis. You document all your contracts, your policies, everything like that, so we can pick up and go. And then, for family members who are kind of actively involved in the portfolio, make sure compensation is clarified and there's a clear plan for that. All of those things can lend to just easing this process and easing tensions in a typically high emotion time when we're talking about these transitions.
Yeah. Kyle mentioned, it's very important to prepare the next generation. As that one kind of started, built this whole thing that has the control, this is grandpa, this is grandma sometimes, that their kids and then their grandkids, each generation loses a little bit, it feels
Yeah.
like. And so you want to just make sure that you're planning for that. And then you're also bringing in, all right, if I can't get the needs in the family, how can I start bringing in third parties? We see a lot of family offices now are treating themselves almost like normal businesses, and they have
Yeah.
employees, things like that running it. And so it's not just heavily relying on only the individuals in the family. So make sure you're preparing that next generation, and you're also figuring out who can get control. And kind of one of the last things I want to leave here is just make sure when you're doing your estate planning, you're also coordinating with your operating agreements. So you might create this huge estate plan, and then I go read your operating agreement, and I was like, none of this, the operating agreement doesn't allow any of this or some of it.
Oh,
And so,
yes.
so make sure that's an important aspect that gets skipped a lot of times is I make this huge estate plan. I don't even think about the operating agreements. Unfortunately comes up a lot. And then we have to be like, you need to amend your operating agreements, and hopefully it's not too late. So just make sure that you're looking at both, because I'm going to say, all right, we're going to transfer all this to irrevocable trusts or whatever. And then the operating agreement doesn't actually allow that.
And Daniel, a lot of times we see that no operating agreement exists in these, right? Like you can have 100 million real estate LLCs and zero of them have an operating agreement. That is bad news bears for so many reasons, but that definitely comes into play here. So starting point one is have an operating agreement and then have someone who knows what they're doing help you craft it. And then all of this conversation for those the real estate that's held within these entities, all of that needs to be grounded in the operating agreement to make sure our estate plan jives with what's allowed based on our company documents.
Kyle. And so I just want to kind of finalize the list with, like, remember, estate planning, it's not just about transferring wealth, okay?
Right.
Not for real estate investors. There is a huge component. There's the income tax component, there's a estate component, but it's also a third piece. You need to be transferring a functioning portfolio to your
Yeah.
next generation, making sure that they're prepared to take it over. They know who's has control. Everyone's meeting everyone's family's goals. So you're not handing them a huge mess. And unfortunately, everything that you built in your lifetime is just is basically, once you pass away, it goes away.
Big
Yeah,
mess. Yeah.
yeah, the huge mess that takes years to deal with. And half the time it ends up by everyone just selling thing off and taking the cash. So you just want to make sure that you're leaving it better than where you found it. And a good estate planning is the perfect way to do that. Thank you. Have a good one.